What are the various commonly used inventory costing methods in the United States? In this video, I will walk you through the dynamics of FIFO, LIFO, and weighted average. If you have watched my prior videos, then you know that the appropriate way to think about accounting for various costs is to ask yourself the question of when do they provide a benefit to the firm? In the case of inventory, does it provide a benefit immediately when it is purchased? The answer is no. When the inventory is purchased, it goes in the warehouse, and at that moment, no benefit is received by the firm. For that reason, when inventory is purchased, the cost that is used to get access to the inventory is treated as an asset. We see an asset called inventory on the balance sheet. When does the inventory actually provide a benefit to the firm? When it is ultimately sold. So that's the moment where the cost stops being an asset on the balance sheet and starts to be recognized as an expense on the income statement. And we call that expense the cost of goods sold. If you haven't watched the prior video where I talk about the basics of the cost of goods sold and the gross profit, which is the very top profit margin on the income statement, then I recommend that you go and watch that video first. In this video, we will get a little bit more into the nitty-gritty of the specifics of how those costs are determined. And the big question is, what happens if the firm experiences a change in the inventory costing over time? So let's suppose that the firm goes out and buys some unit, and the cost at that time is $10 per unit. And then a short time later, they buy some more additional units, and those units are now a little bit more expensive. They're now $12 per unit. And then they buy some more units at $15 per unit. And then the firm has a sale. And the question is, at the point of the sale, which of those costs do we transfer from being an asset on the balance sheet into being a cost of goods sold on the income statement? Is it going to be 10, 12, 15, or some combination? And this is what this video is going to deal with. Let's do a general refresher of the understanding of how the inventory costs flow through our financial statements. When the company starts the period, they have some beginning balance of inventory. Remember, inventory, like any other balance sheet account, any asset liability equity account, is a permanent account. That means that whatever the ending balance is at the end of the prior period will be the beginning balance in the beginning of the current period. And that's, of course, in contrast to the temporary accounts, which are all of our income statement accounts, which start from zero every period. So inventory has some beginning balance. Let's say it's 20, just a theoretical number. And then what happens during the period? During the period, the firm will invariably do some purchases. They will go out and they will replenish their inventory stores. So they will have purchases of $100. So when we think of those two things together, what you started with plus everything that you purchased during the period, the sum of those are all of the inventory that you have available for sale during that period. We call that cost of goods available for sale. So it is not a particular item that you find on the income statement. This is just kind of a conceptual construct that says, if you add up what you had in the beginning plus everything that you bought, this is everything that you could have sold during the period. Now, do you actually sell all of it during the period? For most firms, the answer is no. They will sell some portion of it, and some portion will remain and will carry over to the future period. So those cost of goods available for sale will be split at the end of the period. Some of it will remain on the balance sheet as ending inventory, and some of it will go to cost of goods sold. And mathematically, this is kind of an immutable equation. Beginning inventory plus purchases has to equal ending inventory plus cost of goods sold. They come into the same pool, they go out of the same pool. And of course, the beginning inventory was found on prior period's balance sheet. The ending inventory is found on this period's balance sheet. The cost of goods sold is found on the income statement. The cost of goods available for sale, like I said, it is not a particular item. This is just kind of a conceptual thing that we think of that represents all of the inventory that could have been sold. And the purchases, externally, we don't observe the company's purchasing behavior. This is something that really is seen only inside the organization. But if we wanted to, we could certainly back out the purchases. We could calculate them because that's the only of the 4 items not reported on the financial statements. So the purchases could be calculated as the change in the inventory from prior period to current period plus the cost of goods sold that is reported. And again, the question is when inventory costs have changed over time, when the firm has bought inventory at varying prices, then how does it make the determination which of those costs go into the ending inventory at the end of the period and which of those go into the cost of goods sold on the income statement? Here's where we need to talk about the inventory costing methodologies. Let's first introduce the methodology which is actually not commonly used, the specific identification. This is not a methodology that relies on any assumptions. This is a methodology where the inventory is tracked precisely. You know exactly how much you spent for a specific unit of inventory. So when you sell it, you know exactly which unit cost will be assigned to the cost of goods sold. So kind of a very simple methodology. In reality, it is not commonly used because this methodology only makes sense for companies typically that deal with really low volume items where the units are very specifically identified and very specifically tracked through the system. So usually when we do kind of an illustration of what type of business would deal with this, we think about luxury items. We think about luxury automobiles or luxury jewelry or something of that nature where the company does a very precise job tracking the specific inputs, and those specific inputs are then tracked into the item itself until it is sold. But theoretically, this could be feasible for other types of items as well. You don't really need necessarily to deal with just luxury items as long as inventory is uniquely identifiable and tracked even on a large volume basis, then you could apply this methodology. In reality, it's actually pretty difficult to find publicly traded companies in the United States that follow the specific identification methodology. Probably some of the biggest that I could find are the CarMax and Carvana, which are, of course, resellers of used cars. And we have from their 10K annual reports the disclosure from the inventory footnote saying vehicle inventory cost is determined by specific identification. Why are CarMax and Carvana able to do that? And it's because the automobiles do have unique identifying numbers, so they can precisely track them. But you might be thinking, well, if CarMax and Carvana can do that, then why doesn't General Motors or Ford or other automobile manufacturers, where the final product also is uniquely identifiable by the same number, why don't they follow the same methodology? But the big difference is that CarMax and Carvana are only the retailers of cars. They don't actually manufacture the cars. When they buy them, there is already that unique identifying number, and that's a number that's retained. They only hold the product. It's easy for them to track how much they spend if they need to refurbish it, clean it, anything of that nature, and then they sell it. In contrast, General Motors and Ford, if you think about what their inputs to the inventory is, what are their original costs? Well, there's a lot of raw materials. There's a lot of nuts and bolts and steel parts and rubber parts, etc. Those, unlike the final product, don't have unique identifying numbers or features. So it's much more difficult to actually track which specific bolt went into a car, which specific window went into a car. So it's very different. The final product has unique identifying features, but in terms of the inputs that go into the creation of the product, it doesn't. So if the majority of publicly traded firms in the United States do not follow the specific identification methodology, then the question is, what do they actually do for their inventory costing? And the answer is they have choices. The company can use any of the acceptable assumption-based costing methodologies to assign the inventory cost from being an asset into being a cost of goods sold expense on the income statement. The three methodologies that I will cover in this video are the most common one, which is the weighted average cost, the first in, first out, or FIFO, and the last in, first out, or LIFO. The first methodology that I'm going to talk about is the weighted average. And before we get into the accounting, let's just do a little bit of math to make sure that we're all on the same page in terms of what is weighted average. Let's think about a kindergarten classroom. And in the kindergarten classroom, we have 25-year-olds. Let's suppose that they're all precisely 5 years old. And we have a teacher who is 25 years old. If I ask you, what is the average age of all of the individuals in the classroom? You're probably not going to tell me that the average age is 15, which is what you would get if you would just average 5 and 25. You will say we have a lot more 5-year-olds than 25-year-olds, so we need to do the proper mathematical calculation of the average or the mean. And the answer is going to be 5.95. So this happens when we multiply 5 by 20, which is the number of our kindergartners, and then we add the 25, which is the age of the teacher, and we divide everything by 21, which is the number of people in the classroom. So when we talk about mathematical averages, typically we're talking about weighted average, which takes into account that in a group, we might have pools of different sizes. Here we have a pool of 20 individuals who are 5-year-old, and we have a pool of 1 individual who is 25-year-old. So mathematically, of course, we want our average to be reflective of that relative size of the pools, and 5.95 is the appropriate representation. Now, how does that relate to accounting? We're going to do the same approach when we think about inventory. The company will have pools of inventory that they will have purchased at different prices, and those pools are not necessarily going to be the same. So mathematically, we want to make sure to capture that. Let's use a simple example to illustrate each of the methodologies and to highlight the differences between them. Suppose Wet Umbrellas Corporation started the period with 10 units of inventory. Subsequently, they purchased 50 units and then they sold 40 units. Now, let's assume that the cost of inventory changed over time. The original inventory where they start the period is 10 units at $10 per unit. And then the purchases occur twice in the period, 25 units at 14 and 25 more units at 18. So we are in an inflationary period here. So total cost of goods sold available for sale, which is of course our beginning inventory plus the purchases, is going to equal to $900. How are we going to allocate it to the cost of goods sold? That is based on the 40 units that are sold versus the ending inventory, which are the 20 units that are remaining. For the weighted average, we're going to start with the cost of goods available for sale, and we're going to divide it by the number of units available for sale, again, based on the beginning inventory plus the units that we have purchased in this period. That's going to give us the weighted average cost per unit. We're going to multiply that by the number of units that we sold to get the cost of goods sold, and we're going to multiply it by the number of units that are remaining in the inventory to get the ending inventory on the balance sheet. And again, something that I won't really get into in this particular video is the differences between the periodic and the perpetual inventory system. In the perpetual system, which is very common, you can think of this as being automatically done. It's a moving average where with computers, it's really easy to continuously update what is our most recent weighted average cost per unit. So let's apply it to our wet umbrellas. The beginning inventory is $100. We have 2 purchases. If we sum up the beginning inventory plus the purchases, we have $900 as the total goods available for sale. We're going to divide it by 60 units, and our weighted average comes out to be $15 per unit. Thinking back to our kindergartners, notice that the $15 is not actually just the arithmetic mean of the numbers 10, 14, and 18. And that's because the pools are not of equal size. We only have 10 units, which are at the cheaper $10 per unit price, but we have more units at the more expensive price, 25 at 14 and 25 at 18. So it makes sense that the weighted average cost is a little bit closer to the cost of the bigger pools. So if this company follows the weighted average methodology, then the cost of goods sold is going to be the 40 units times the $15 cost per unit, or $600. And the ending inventory will be the 20 units that are remaining, again, times the 15 is equal to $300. Let's jump to the next methodology, the FIFO, which is the first in, first out methodology. We can think of this methodology as a conveyor belt. The first costs which are entered into the system are going to be the first costs that are moved out of the system. They're moved out of the asset account on the balance sheet and into the expense account on the income statement. So they just kind of flow through on the conveyor belt. The very last costs that are entered into the system are the ones that are still going to hang out in the asset account, in the inventory, on the balance sheet. Now, very, very important to understand here is when the company makes the choice of which assumption they want to use for the inventory costing method, that choice is not at all tied to how their inventory physically flows. So they could choose the weighted average, they could choose the FIFO, they could choose the LIFO that I'm going to introduce in just a couple couple of slides, and it doesn't have to match to how they actually operate in their business. In reality, in terms of the actual flow of goods, most firms probably follow FIFO, and that's because that's the method that will minimize the obsolescence, that will allow you to move the older product out, that kind of runs less of a risk of having things in your warehouse which need to be trashed because they're no longer sellable. Not everybody, some firms, especially if you're dealing with commodities where they really don't get obsolete, they don't go stale. If you're dealing with coal and oil, etc., it doesn't really matter. But again, remember that the physical flow of goods does not determine which assumption you have to use. This is an accounting choice only. Let's assume that our wet umbrellas company follows FIFO as their methodology choice. They will say, well, first we sold that were part of our beginning balance of inventory. So 10 units originally bought at $10 per unit, those are sold. And then we sell 25 units from purchase number 1, which is the earlier purchase. And then we sell 5 units from purchase number 2. That gets us to the total 40 units that we sold. So if we sum up the dollar amount, the cost of goods sold under the FIFO methodology should be $540. What units do we still have remaining in inventory at the end of the period? Well, the last 20 units from purchase number 2 are still remaining in inventory. So 20 units at 18, the most recent, the most expensive purchase, are going to remain as an asset on the balance sheet. And the dollar amount there is going to be $360 as the ending balance. Let's contrast this to the last in, first out, or the LIFO methodology, which, as the name suggests, is going to be exactly the opposite. Instead of thinking of it like a conveyor belt, we're going to think of it like a vending machine. The very last items that are added to the machine are going to be the first items that come out. So the very last cost, the most recent inventory purchase pricing, is going to be the first one, which is going to be assigned from the asset on the balance sheet into the expense cost of goods sold on the income statement. So the ending inventory is potentially going to be based on very, very, very old input prices. This is the items in the very back of the vending machine. And again, I just want to highlight, this doesn't mean that the company actually sells their goods in this manner. There could be a disconnect between how the physical flow of goods happens within a firm and which assumption that they're using. They could follow the FIFO in terms of their actual physical approach to the inventory, but still elect to do LIFO for their accounting assumptions. For the same wet umbrellas company, we will say, well, the cost of goods sold first gets the most recent purchase. So we're going to take purchase number 2, which is 25 units at $18 per unit. We're going to assign that to the expense first. And we're going to take 15 more units from purchase number 1, which is a little bit older. So 15 units at $14 per unit. And then we stop, because once we do that, 25 plus 15, then we have fully accounted for the 40 units that we have sold. The cost of goods sold is going to be $660. What units are we still going to have in inventory, in the asset inventory, carried over to the next period? The ending inventory is going to be based on the oldest units, which are 10 units at $10 that we started the period with. So we haven't dipped into those. Those have remained. And we have added an additional layer, 10 units at $14, which was from purchase number 1. So our ending balance of the inventory is going to be $240. So just to pull all of the 3 methodologies together from the same problem for illustration, what did we calculate the numbers to be? For the weighted average, we had cost of goods sold of $600 and ending inventory of $300. For FIFO, we had cost of goods sold of $540 and ending inventory of $360. And for LIFO, cost of goods sold of $660 and ending inventory of $240. When we have an inflationary environment, when inventory costs go up over time, which is true for most firms, most periods. In this situation, the FIFO is going to give us the lowest cost of goods sold, the lowest expense on the income statement. The LIFO is going to give us the highest expense on the income statement, and the weighted average will come in somewhere in the middle between the two. Again, that holds on average when inventory unit costs are increasing. FIFO gives us the highest balance of the ending inventory asset on the balance sheet, the lowest cost of goods sold, and as a result, the highest gross profit. LIFO gives us the lowest asset inventory on the balance sheet, the highest cost of goods sold, and the lowest gross profit, and the weighted average will give us the results which fall somewhere between LIFO and FIFO. Now, keep in mind, while for most firms' inventory unit costs are increasing on average, there certainly might be periods where inventory unit costs are decreasing, and then the choice of the methodology will have the opposite effect. So specifically in the periods where inventory unit costs are deflationary, they are decreasing, FIFO will contribute to a lower inventory asset as compared to the LIFO methodology, but it will give the highest expense and the lowest profitability. The LIFO will give a lower expense and correspondingly higher profitability, and the weighted average does continue to be in the middle of the two. That was a brief introduction to the inventory costing method. In the next video, I will talk more about the LIFO disclosure that allows us to improve comparability. What happens if we have a LIFO firm and a FIFO firm, and we want to do some analysis? We're going to have to convert the LIFO firm to how it would have looked as a FIFO firm. So stick around for that discussion. I hope that you enjoyed the video. If you did, then please like, subscribe, share it with your colleagues and friends, and I'll see you in the next one.